All right, welcome to today's show. So I'm going to jump in and talk about Saylor and the Bitcoin empire that Strategy is creating today. We're going to jump in and talk about the big buy that they made of $760 million. And also going to talk about the Genius Act that just changed the game for stable coins. And we're going to jump into all of that and more today. So quick disclaimer, not financial advice, not tax advice, not legal advice. Do your own research on this, and everything here is for educational purposes only. So the big buy today was clearly a big deal, 760 million. But what I'd like to talk about in today's show is we're going to get into what happened with the stable coins, which is really, really big news in the market today. But also I want to talk about the 4 ways that Strategy actually buys Bitcoin. And so when we're looking at this, a lot of times people have questions of what are these instruments that Strategy is using, and I'm going to break them down mathematically. Anthony says, exciting day today and yesterday for Bitcoin. Absolutely. I think we're sitting today with Bitcoin at 106,273. So big news. The close for Bitcoin at the end of this last week was huge, the biggest close in history. So it's all big news. But let's break down Strategy and jump in. And I want to break down the math of this because oftentimes people look at Strategy and how they're buying Bitcoin, and they'll look at Strike, they'll look at STRIFE, they'll look at the convertible notes, and they'll look at the issuing of common shares, which are the 4 instruments that they use to actually buy Bitcoin. And I'm going to break it down conceptually based on my understanding of it and make it super simple. And many times one may look at it and go, hey, well, I'm an individual and I'm buying common shares of Strategy. And what about these institutions or these pension funds that are buying up these convertible notes or buying up STRIFE and Strike, and what's the difference? And mathematically, what would that mean to me if I could potentially buy a convertible note? Let's just say hypothetically I could. What would that mean to me in dollars if I owned a convertible note versus if I owned Strategy outright? And what are the risks associated with it? And why are institutions flocking to some of these products? Because of the riskier nature of some of these products that give the upside potential for larger institutions, but also the conservative nature of these products compared to MSTR as the common shares that we own. Okay. So I'm going to break it down right now and walk you guys through this. All right. So basically when we're looking at these different instruments, we want to I'll start off by going through STRIFE. And if you think about STRIFE, it's kind of like, this is an analogy like a juiced up savings account. All right. And investors who've been buying STRIFE when they first came out with it, and you can look up the price right now. But when they first came out with it, people were buying this up at $100 per share. So it is a preferred stock. All right. And people are buying it up at $100 per share. And the reason why it was so interesting is because it can get a 10% annual return based on buying it at $100 per share. And so if I get 1 share at $100, that 1 share at $100 earning a 10% return would make me $10. Okay. So essentially it's $10 per share that one owns. So STRIFE is interesting to people because it's just fixed and it pays out, and Strategy, has to pay it, so to speak. But if their cash position isn't so good and they don't pay it, then the dividend that they owe can stack up as high as 18%. All right. So when you think about STRIFE is more like just a very more conservative fixed instrument. And you wonder why institutions would gravitate towards this. I mean, they could go get 4% somewhere else, or they could invest 4, maybe 5% somewhere else, or they can invest in STRIFE and potentially make 10% over the year. So if you break this down and you look at it, I'm going to draw it out so it's simple on the screen here. And I'm going to go old school and sketch it here for you guys. But if you look at the simplicity of this here, and you look at $100 per share, right, of STRIFE, and then you look at it paying 1 share is going to pay you $10. So that's how it works. You get $10 per share. So that essentially is a 10% rate of return. Make sense? So people are attracted to that because they're like, wow, I can make 10% on my money. I just put it in. That's a hell of a fixed return. Like that's a freaking game changer. But let's say Strife was down and somebody bought it at not $100 per share, but they bought it at $70 per share. Okay. Because it can fluctuate. With that $70 per share, they would earn $10. And so if you have $70 and then you make $10, that's upwards of about a 14% return. Make sense? So the potential on this thing, like you're either going to make your $10 up here, which is 10%, or you're going to make your 14% down here. Make sense? If the shares of Strife, if the price fluctuates or drops. All right, so that's the basic on how Strife works, and the simplicity of what it is, and it's why people are interested in they're using it as an instrument to actually raise more money to buy Bitcoin. And that's just a very simple way to explain what Strife is. Okay, so now if we take a look at Strike, which was used today. Strike is another form of preferred stock, but it's convertible for preferred stock. And so the difference between Strife and Strike, and if you look at the big purchase of 760 million and change that Strategy bought today worth of Bitcoin, a portion of what they used to buy Bitcoin was their preferred stock of Strike. And so I think it was about $59 or $60 million of this preferred stock. So how does Strike work, and why is that attractive to people who actually invest in it, and what rate of return do they get on this? So I'm giving you a concept of how this works here, and then I'm going to compare it to like, okay, if you're an institution investing in this, what's your rate of return? And if you're somebody who's a common shareholder like I am, what would my rate of return be? Now, comparatively with Strife, which pays out about 10%, if you buy it at $100 per share, it pays out about 10%. Comparatively, there's no comparison. If I put $1 million into Strife, I'm going to get a 10% return. I make $100,000. If I put $1 million into Strategy and the stock goes up, I could make 3x, I could make 4x, I could make 2x, I could lose money on it. All right. So the potential that one would make in investing in common shares of MSTR versus investing in Strife is two totally different ballparks. You're talking about the difference of 10% versus 100 or 200 or 300%. And so the upside potential is huge for common shareholders, but the downside is also big as well. So that's what you have when you're looking at that. Now, today they use Strike to buy additional Bitcoin. So when we look at Strike, let's take a look right now at what Strike actually does, because Strike is an interesting vehicle as well. So it's still $100 per share. Now, if you go look it up right now, I think last night when I looked it up, it was $98 per share. So it does fluctuate when you go to buy Strike. But when they came out with it, they're like, okay, we're gonna offer it up at $100 per share. And they went even lower with Strike at that time, I believe, to get more investors when they raised their initial capital for Strike. But basically, let's say essentially $100 per share. Now, this pays an 8% dividend. So the way that this is different than Strife is Strike is different because it's an 8% dividend, and Strife has a dividend also, which is about 10%, $10 per share. But Strike is different because the $8 dividend is you're going to get paid. That's a fixed payment that you're going to get. But the option for people who own Strike is they have an option when Strategy goes to $1,000. If it goes to $1,000, at that point, they can convert into stock. So if they're buying it at $100 and then Strategy is going to go up to $1,000, they have an option to convert at $1,000. Now, this is a little bit confusing because when the offering for Strike and Strife came out at $100 per share, the MSTR common share stock price was much higher than that. It was something like $330 or $340. Fact check me on that, but it was approximately around that. So it gets a little confusing because there's like MSTR common shares is $330 at the time, and they're issuing this for $100 per share. So just track me with the math on it, okay? So in the example of Strike, the reason people would be interested in that is, okay, I'm going to invest my money into Strike at $100 per share. If I believe that Strategy is going to go past $1,000, then I can convert to the common shares above $1,000. So now if Strategy goes up to $1,100, I got a gain. If it goes up to $1,200, I get a gain. If it goes up to $1,300, I got a gain. So I take my 8% dividend that I'm getting off the stock with Strike, and then I add in the returns if strategy goes past $1,000 price point, and then I'm getting real common share returns off that. Make sense? So I have the potential not just to make, if I put $1 million in, not just to make 8% or 80,000. I have the potential, if it goes to 1,100, 1,200, 1,300, 1,400, make way more money, and then my $1 million turns into not 1,080,000. It turns into 1,200,000, 1,300,000, 1,400,000, and beyond. Make sense? So people who are investing in Strike are wanting the dividend, but they're believing that it's going to go up long term. Okay. And so they're betting the strategy eventually will blow past $1,000. So that's how Strike works. Now, let's go in to take a look at convertible notes. If you're just joining us, this is the one that I'm going to break down to look at if you invested in a convertible note. Institutions are doing this. Pension funds are doing this. We're not doing this. But if you invest in a convertible note, like what's the upside of why a company would want to do this? And when you look at the convertible notes, in my opinion, I run the numbers. The convertible notes are super hot. Now, depending on what price point you get in the convertible notes, they can be extremely hot for investors. And here's why. Okay. So let's just look at the properties of it first, and then I'll sketch it out for you so you can actually see what I'm talking about mathematically. All right. So when you look at a convertible note, you'll hear the term that's used sometimes on this zero coupon bonds. And so what zero coupon means is no interest payments. So basically they go to strategy and they're like, yo, here's $1 million. And in some of these cases, like here's $1 billion, right? Here's $1 billion, right? And they go to strategy, and strategy gives them a note. And the note is basically an IOU. So it's like, okay, give me $1 billion. I'm strategy. I take it. I give you a note back. Okay. And that note's like an IOU for $1 billion. Now there's a time period on this. And at some point in the future, strategy basically says you have an option to convert the money that you give me into stock. So they're called convertible notes because not only is it strategy, give me $1 billion, I give you a note. That's what note means. You hold the note. That means I owe you $1 billion. If nothing happens with strategy and strategy goes to crap, then basically I'll give you your $1 billion back with no interest though. So when you hear zero coupon, it means no interest. So there's no interest payments paid. But when the stock hits a certain price, it's called a convertible note because you can convert that note into shares in the future, and you can ride the wave of the stock going up, and you can make a lot of money. Make sense? So it's an option to convert into MSTR stock. Now, basically, if you take a look at it, if you look at the November converts, I'll take a look at the November convertible notes and draw this out for you. Because if you're a common shareholder like I am, or you're somebody who invests in convertible notes like institutions, as a common shareholder, I'm going to be way better off in the future when strategy hits, goes to the Mecca and hits the gold mine, right? So I'm going to be way better off mathematically, and I'll show you the math here in a second. But just the concept of how this works with these convertible notes is interesting, because when you look at the example back in November 2024, the stock price that they were given when I think they raised like $3 billion in convertible notes, then the stock price they were giving people at the time to buy in was $433, which is kind of interesting because when you look at the price right now, Bitcoin, it's a strategy, it's $418 after hours. So let's take a look at this. I'm going to draw it out for you, and we'll just look at this in terms of the math. So let's go here, and let me sketch this. All right. So let me get rid of this mess here. So if you look at the convertible notes, which I think is kind of interesting. We have some things that we don't want to erase, but anyway, we got a little bit of a mess here. But if you look at the convertible notes here, all right, and let's just say I bought in back in November into these converts, right? So at the time, these converts were going at a price point of the stock for strategy was sitting at $432 when they bought in at these converts. And the basic idea was that if you buy in at $432, they have on it what's called a 55% premium, which basically means with this 55% premium here, it basically means that you cannot convert into stock. So if you give me $1 billion, you cannot convert into the stock until it's 55% over this $432 price point that you bought in. And if you do the math on that, that works out to something like 600, I think it's like $670 or something like that. Make sense? So you have 670 bucks over here. So they can't convert into stock. If you're an owner of these convertible notes, you can't convert into the stock until it reaches $670. The moment you convert into it at $670 and it goes up, the share price at that point, you are now own the common shares of the stock. So you're in the game like the rest of us. And the moment it hits above that price, you can ride the wave up, and everything over that, you're making gains on the common shares that you hold. But the math on this works very simply like this. If you were to put in $1 million at this $432 price, again, it's a 55% premium. So basically, it's like you're paying 55% over the current price that you're buying it at. So that means you can convert at $670. So if I put $1 million in, all right, if I put $1 million in, that means that, and strategy goes up to $1,000. That means as a convertible note holder, I can make about $1.5 million. Does that make sense? Okay, if you do the math, that's what it works out to. So as somebody who owns convertible notes, I'm like, okay, I'm buying at 432 bucks here. I'm buying in at this price point. And that's where I'm giving you my $1 million, let's say. It's a premium, so I'm paying a premium 55% over the actual price. So I can't convert until it gets to about $670. And so when I do convert, the math works out roughly to 1.5 million if strategy, the stock, eventually hits $1,000. All right. So now if you're a convertible note holder, you're looking at this and you're like, all right, well, this is kind of interesting. As a convertible note holder, I put in $1 million. If strategy goes to $1,000, then I'm making about, my million goes to $1.5 million. So I'm making about a $500,000 gain. Make sense? Now, if I were to buy common shares at that price point, and I were to buy $1 million of common shares at $432 MSTR, and it goes to $1,000, my million becomes about 2.3 million. So if I'm a convertible note holder, I make about $500,000. If I am a common shareholder, I put $1 million in and it goes to 2.3 million. I make about 1.3 million bucks. Does this make sense? So that is the basic idea of how it works when you compare the convertible notes and you compare it to actual common shares. The common shareholder will always beat the convertible notes if the stock moons. The common shareholder will beat STRIFE because STRIFE's paying out 10%. The common shareholder will beat STRIKE, which is paying out 8% dividend. And if it goes up above 1,000 strategy, the price point, you can convert over 1,000, but the common shareholder will still beat that. So when you look at why does Saylor have all these different types of these 4 different vehicles that I talked about today, one is STRIFE at about a 10% payout. One is STRIKE at an 8% dividend that you can eventually convert if the strategy price goes above 1,000. One is convertible notes that people are basically paying a premium. So they can convert sometimes in the deal they did in November at a 55% premium. And so you have the convertible notes. Institutions like those because it's conservative. If strategy goes to hell, they get their $1 million back or their $1 billion back. But if strategy goes up, they win the game. So there's limited downside on these convertible notes, like very low downside. And then STRIFE, there's very limited downside. And STRIKE, there's limited downside, which is why these institutions are investing their money into strategy. For the common shareholder, there's very heavy upside and very heavy downside as well. So that's the basic idea of how these work. And it's an interesting game to see it. But I thought I'd share this with you today because I think it's fascinating to see how these 4 different vehicles work and why it's attracting all different kinds of money that's flowing into strategy, which makes strategy a very, very attractive and lucrative opportunity. Somebody's saying you missed a 3x return if you wait for a split. So somebody's, we had the JW experience in here. We got Chris R in here. We got a bunch of people in here saying hello. Hello, everyone. How are you? We got Daniel in here. We got Anthony here. We got Westchester in here. So yeah, so that's the idea of what happens with the 4 different instruments. Now, let's jump in and take a look at what's going on with the rest of the game today. We know that today the strategy sold 1.71 million shares and for $705 million. And so they took $705 million and they bought Bitcoin, and they also sold 621,000 strike shares for $59 million. All right. So you put that together and you get your roughly 760 some odd million dollars. Right. And they bought Bitcoin today, which is 7,390 Bitcoin is what they bought. Not today. They bought it over the weekend or prior. But and the average price that they bought Bitcoin at with this purchase was $103,498. So their total stash is about 576,000 that's into Bitcoin in terms of 576,000 Bitcoin. And they bought Bitcoin at an average price of about $69,000, and they roughly hold it around 40 something billion dollars. Okay. Might even be more than that, actually. I think it's more than that. So also the other news that came in is that there was a lawsuit. You know, when you're growing and you're thriving, people come out of the woodworks and they're slapping a lawsuit on strategy. Not disclosing risks around Bitcoin's volatility is one of the things they're getting hit with. Claims around treasury strategy profitability and misleading investors is basically what the lawsuit is. Despite all that, strategy stock is up. So they're fighting it. Lawsuits will come and go in this situation, but the Bitcoin stack keeps growing. So that's really interesting. Okay. So let's get into the Genius Act here and talk a little bit about the stable coins and why this is actually really, really good. Why this makes a lot of sense for US banks, why this is really good for crypto, why this is great for regulation, and why this is good for the issuers of stable coins. So let's jump into that and see what's happening here. So the Genius Act, it advanced in the US Senate. It's a big win for crypto. It's definitely a big win for banks. All stable coins must be backed 1-for-1 with real US dollars, or they can actually be backed by T-bills. If you don't know this, one of the ways that the issuers of stable coins make a shitload of money is instead of putting their money into dollars, they put it into T-bills that pay out a lot larger return. And so the issuers of stable coins are making a huge amount of money rather than depositing dollars to put it in T-bills. Okay. Stablecoin issuers, they have to register inside the US. So this is part of the Genius Act. They have to register inside the US. So in doing that, if you're going to issue stablecoins, you got to do it inside the US based on the laws here in the United States. Okay. If you're doing it here as a company inside the United States. And the good news is if you're a bank, you're happy about this because every dollar, every stable coin that's issued needs to be backed by $1. And so if you're a bank, you're like, well, this is good because they issue a bunch of stable coins and then they got to put money into my bank and they have to back their stable coins with my dollars. So it's a way that's linking crypto to the bank. Some people like it, some people don't. But if you look at in terms of regulation, it's a good thing. And if you look at in terms of traditional finance in the crypto world merging, well, take a look. It's actually happening right now. So stablecoin issuers, they're basically those reserve dollars are being held in the U.S. banks. The U.S. banks are basically the custodians of this. If you break it down pretty simple, I have to keep $1 in real money for every coin I create. I keep it in the U.S. banks. So for the banks, they get more deposits. They're also getting more customers as a result of this. They also get to charge more fees as a result of this, and they get more control over crypto money. So banks basically just got a seat at the digital dollar table, and they're quite happy about it. They now hold the keys because they're controlling the cash to a certain degree. So they hold the backing, the backing dollars for these stable coins. They can also manage the T-bills for yield. So if I'm an issuer of stable coins and I want to put it into T-bills instead of dollars, I can do that. And so, the banks can obviously issue this, and they get to process and transaction, offer the custodian services, and it's a good deal. So basically, that's what's going on in the marketplace. Let me know what your thoughts are. What do you think about what's happening with the stable coins? Do you think it's a good thing or a bad thing? And what do you think is happening with strategy right now? I think it's pretty fascinating to see what's happening in the marketplace. Bitcoin, I think, is going to hit an all-time high this week. Not financial advice, but I think we are going to hit an all-time high. And if you look at strategy's price or Bitcoin's price right now, it's sitting at 106,000. If we look at MSTR's after hours price, MSTR's sitting at 416,000 after hours. So it's a little bit up after hours. And what are you guys thinking about the MNAV right now? If you look at the MNAV, some people are saying, hey, every time he hits the issues more common shares. People are like, oh my God, he's tapping the ATM and it's crushing the MNAV. But ultimately, Saylor's strategy is to get us more Bitcoin per share. And every time he issues more shares and he buys Bitcoin with that, he's getting us more Bitcoin per share. And as a strategy shareholder, that's what we want. And that's also adding to the Bitcoin yield that you're seeing him talk about. Every time he decides to buy more Bitcoin, he's talking about the Bitcoin yield as well. And so the Bitcoin yield is a positive thing, as that's going up for us as well. So overall, it's good. If you're new to what he's doing with issuing shares to buy Bitcoin, it's pretty simple. There's a temporary dilution. So when you issue shares, you put more paper in the marketplace, meaning more MSTR stock in the marketplace. It's like, hey, we're issuing more paper. Give us a little bit of money for that. So he issues more paper. It dilutes the stockholders temporarily. But with that additional paper, he takes the cash in exchange for it and he buys more Bitcoin. And so the minor dilution of this stock has a major increase in accretion of the Bitcoin. And so more shares in the marketplace, but much more Bitcoin for the shareholders. And so it's a win. So all day long, what do you care, or what do I care, if he's issuing more shares and it's accretive and there's more Bitcoin per share that's happening? We're happy about that. And if you look at the chart since 2020, MSTR has been increasing its Bitcoin per share more and more and more and more. And if you watch their strategy over the next 4, 5, 6 years, you're going to see more and more and more Bitcoin per share, which is really, really good for shareholders. So that's the basic deal. Hope this serves you guys. And the recap is really simple. If you're just joining us, it's 4 instruments is how he's crushing it in the marketplace. Issuing shares to buy more stock. That's what he did big time today. Or I should say that's the strategy did. Convertible notes, brilliant strategy, huge upside potential for institutions that are buying into these notes. STRIFE and STRIKE, I think, are brilliant products because they're attracting a different kind of investor, people who want more fixed income and they want dividends of 8% or 10%. If you get involved in STRIKE, you get the upside potential. If strategy crosses $1,000, you get upside potential. With STRIFE, there is no upside potential with the stock. It is just a fixed payout. And that's how he's doing it. And that's how he will continue to do it. And who knows if he'll come out with more instruments to buy Bitcoin. I'm sure they will invent something new in the next 6 months to 1 year. But ultimately, if we look at the future, I'm bullish of what's happening with strategy. I think the MNAV will go back over 2. If it's not quite over 2 right now, it's probably hovering around that. And I think it's blue skies for strategy. And if you look at the prediction of what people think is going to happen with Bitcoin, a lot of analysts have changed their prediction of what they think is going to happen. And there's many that I recently looked at that think Bitcoin's going to go over $200,000. So if you take a look at that and you go, hey, Bitcoin crashes, Bitcoin not crashes, Bitcoin goes over $200,000, what potentially could happen for strategy stock? You can decide on what happens as a result of that. It typically will do a 2x. So that's the benefit of holding strategy. And if you look at strategy's returns over the last year or 2 years, Bitcoin goes up by X, strategy goes up by X plus more. And that's why people own strategy. Ultimately, if we look at a peak potentially happening in October or maybe December, you look at the tariffs that happened earlier this year. Over those 2 months period, there was a lot of craziness going on in the marketplace. People were flipping out. The economy is going to go into recession. Everything's ending. But when you look at the rebound of the stock market recently, the NASDAQ has recovered nicely. The S&P 500 has recovered brilliantly. We have, strategy and Bitcoin are way up again. And so when we look at the future potential of what's going to happen for strategy, I think strategy is going to go to the moon. But also I'm looking personally, and this is not financial advice for anybody, but I'm looking personally at what strategy does moon in October or December. I think it's going to moon between October and December. I'm definitely taking a large degree of profits and will not be riding that up and down. I love strategy because it's super volatile and I love the upside. But also I'm very mindful of the fact that we could go up to $1,200 and crash down to $300, or we could crash down lower. Who knows? So I've been in strategy, in case you're wondering. My first shares I bought in 2020, and then I sold them, and then I bought back in 2024. In February was my next buy-in in 2024. So my initial buy-in to strategy was at $79. So, you know, everybody's got to look at their positions of when they bought into the stock. And then you have to look at it from your viewpoint and not financial advice. But if I was doing this myself and I bought in at $79 like I did, I'm obviously in the money on those buys big time. And then if I look at buying in at, say, $400, which I put new money in about 2.5 months ago when strategy was around 400 and something dollars. So I have new money in at that price point. Excuse me, not 400 something dollars, $330. So I have new money in at $330. And so when I'm looking at that new money, I'm treating it differently than money that was in at $79 or $100 or $125 per se. Make sense? So you really got to look at it. And people who bought in late, if I bought in late and that was the only money I had in strategy, I'd be watching it like a hawk, because if I bought in at 330, doesn't mean that, you know, as we run into the bull, it couldn't crash down below 330. And I've seen this thing move over the last, you know, year and a half, let's say, since February. So March, April, May, June, what are we? That's 15 months of really owning the stock heavily. So I've seen it move, and I've seen it move up, and I've seen it move up and down 50% multiple times. So, you know, when we saw this quote unquote crash a couple months back, that wasn't the first time the stock's done that. If you look back in 2024, it did it a couple times. It went up and dropped all the way down. So it moves in a very, very volatile way, and you just got to pay attention to that. Okay. And yeah, the JW experience, I didn't read the entire lawsuit. I read an article on it. I think it's totally baseless. And, you know, as people grow and they grow big, like strategy has, like, you're going to have people coming out of the woodworks who just want to attack them. That's just kind of how life goes. So, so I think it's baseless, but I'll read the facts and the data, and I trust what you're saying on that. So, so anyway, you just got to look at this and what's happening, and you just got to pay attention. So my viewpoint is, everybody's going to make their own choice. Everybody's going to make their own decision. Everybody needs to do their own research. And, you know, and I'll share when I'm looking at selling out. Right now, I'm not looking at selling out anything at this point, even though I'm heavily in profits with my initial buys, because I think the upside is huge. And if Bitcoin does go to 200,000, that's a double from here, a little less than a double. What do you think strategy is going to hit? You know, if Bitcoin doubles, you know, obviously strategy is going to double, right? I mean, so you're talking 420 to 840 if Bitcoin doubles and goes to 200K. But we know that strategy doesn't just double. When Bitcoin doubles, strategy doesn't double. It goes up by way more. So if Bitcoin doubles, what could strategy hit? Yeah, I think you're looking at a minimum. If Bitcoin doubles, it's hitting 1,000. And just logically of how the stock's moved already, it should hit 1,200 at that point. All right. So, and then if you're really looking at it, if the MNAV is hot, we could be looking at a $1,600 price point. And if you really want to get bullish on it, you'd be looking at a $2,000 price point. Okay. Now, this is just theoretical. Don't even bet anything on what I'm saying on this. I'm just saying this is what's possible. And if you see the sentiment in the marketplace today, people are very bullish right now who own Bitcoin and understand strategy. There's other people that have a completely different perspective. Okay. So I think it's fascinating. I think it's time for a change. I love what Saylor's doing, and I love the other companies that have been following and taking suit, you know, whether it's, you know, CEP or, you know, you got other companies that have gotten in the game recently. I think it's interesting to see what's happening, and more people are stacking Bitcoin in their treasuries, more and more corporations, I should say. So, so we've got people thinking, what are you guys thinking in the chat? You think we're going to go higher than where we're at right now? What do you think? Hello, Sandra. We got James in there. What's up, Bar? I got James Barber. My buddy's in here. So from front run in the S&P can push it higher too. Yep, that's right. Yeah, so interesting data. Everybody's got cool data here. So anyway, that's my no, I somehow I just popped this on here. that you posted, the JW experience. But I think it's interesting for everybody to check out what happened with the lawsuit, and just make your own opinion on it based on facts. All right. So I agree with you, JMF. It's not if, it's when. I totally believe that, and I don't want to give out any financial advice or give out anything that would have somebody make a bad decision, because I know we have people on this channel that are brand new, and you might be looking at it and going, wow, things are mooning right now and it's going to go to the moon. I personally believe that we are going to see an $800 strategy in this run, and I personally believe we're going to see a $1,000 strategy. That's how I'm placing my bets, and I'm also planning for a $1,200 strategy. That's my plan. So you just got to look at what your plan is and what you think potentially could happen. And perhaps, if I'm doing this and I'm brand new, I would be looking at, if I got involved recently, what are my exit points of when I want to exit, and have a chart mocked up and go, hey, here's where I'm at right now. I bought in at $330. If strategy goes to $660, I just doubled my money. Do I want to take chips off the table, and see what happens? So you just got to think what's best for you, and think what's going to be best for your investments. I kind of treat Bitcoin as, for my company, I have Bitcoin in reserves. For personally, I have Bitcoin in reserves. So Bitcoin's kind of my reserves. And then I look at strategy as my, I buy in and I let it rip. And it's my get rich strategy. And these are the two companies that I'm invested in right now. I emptied out my Tesla in early 2024. And that's when I bought into strategy. So I think that was a good move. At the time, Tesla was like $200 and strategy was like $79, right? So, and I think, Tesla is obviously a great stock, and I think it has a great future. But these are the two that I own, and that's what I'm betting on over the next 6 to 9 months, and we'll see what happens. All right, so I hope this serves you guys. I'm going to end the stream now. You can like it down below. When you like and you chat, put comments here. It doesn't show up on YouTube. So if you're on YouTube, when I end the stream, if you go put some comments in YouTube and like it, that'd be great. And if there's anything you want to know more about, based on my opinion and research that I've done, let me know. I'm happy to share it on the next show. Somebody's asking, which two do I own? What do you mean by that, Michael? In terms of Bitcoin and strategy, I own Bitcoin and strategy. I also own another version of strategy that's a leverage play, but somebody's talking about MSTX there. That's obviously a highly leveraged play. I do own some MSTU, but you really got to do your research on that. It's highly, highly, highly speculative, and it's very, very, very risky. You can have a huge upside potential, but you can have a huge downside on it. So those are more leverage plays on it, and those are not actual, like MSTU, MSTX are not things or instruments that strategy actually has created. Like they obviously created STRIFE, Strike, MSTR shares, and their convertible notes, but they're not involved in MSTU. You just have people creating these products, which are ETFs, MSTU, MSTX, or ETFs. And so you have companies that come together and they create these products, and they're just leverage plays on MSTR. And the bet on like an MSTU or an MSTX is that it's going to go up two times what strategy goes up on the daily, not over the long term, and on the daily. And the thing that people are worried about with these products is over time, these products, they erode over time. So the longer you hold them, if the market goes up and down a lot, the returns erode on these products. Now, I'm not saying they're bad. I'm just saying you really got to understand this. I'm also saying they're extremely risky. And I'm also saying that I do own them as full disclosure. Okay. So that's kind of the idea. Anything you do, like if I was brand new to this, when I look back in 2018, when I got into strategy, I'm actually coming out with a book called My Bitcoin Strategy. And it's a breakdown on the evolution of money. And it talks about the debt crisis in this world, and it talks about all the different financial products in the world. You might not know this, but the first decade or 12 years of my life, I was in the financial services business. So from the time I was 21, I was involved in these different financial products, from mutual funds, insurance products, annuity products, all different kinds of investment products, 401k products, all of that. And so when I was involved in this at 21 years old, I started doing my research, and it never made sense to me. When you look at the fees, like if an investment advisor charges you a 1% fee on your investments, you lose a huge chunk of your return over a 20 or 30 year period. So try to take a look at investing $100,000 and putting with an investment advisor that charges you 1%. And that $100,000 that grows over 10% over a 20-year period, if you have the 1% fee, it erodes your wealth and eats at it drastically. If you don't have the 1% fee, you're going to get the true 10% growth on your money. So it's crazy how a 1% management fee just destroys your wealth. People think, oh, it's 1%. No, it's destruction of one's wealth. It's total erosion. It's not worth it. So in my early 20s, I was involved in all these different financial products, and so much so that I was part of a group that did something called personal financial engineering, and it looked at the rate of return of all of your money. So it would take a look at all the investments from your 401k to your mutual funds, to your stocks, to your insurances that were costing you money, to your bonds, to your real estate, to all of it. And the whole idea was to look at the rate of return of all your money, and you look at it holistically. So if one is making 10% on investment, but they have, 8% they're paying on debt, obviously their rate of return is not 10%, right? If you look at putting money into an investment of like, I'm going to put money into a 5% investment, I also have to look at the lost opportunity cost of if I were to put that money into something could earn 20% or 30%, that's lost opportunity cost, right? So when I started to look at this and do personal financial engineering in my 20s, I started to look and go, wow, what's the rate of return on all of your money? And so I started to look at the fees in these insurance contracts. I started to look, I just literally emptied out my insurance contract and put it all into strategy 2 months ago, right? So I started to look at the fees in these insurance contracts, fees for older people on annuities, fees on mutual funds, fees on investment advisors, costs of insurance, inflation, debt. And when you start to look at this, the reason I wrote this book that's coming out in the next month and a half is you start to look at this and you look at the rate of return on all somebody's money, and you realize that's why the world's in debt. That's why people are in debt and they're not surviving. And it's not that somebody's doing anything wrong. They're trying to do what they're told. And it's not per se that it's wrong. It's just not survival based. So I guess you might say that's wrong, right? It's a joke, to be quite honest. And so I got interested in Bitcoin in 2018. That's when I bought my first Bitcoin, when it was around $3,000. And then I got fascinated with it in 2019 was when I called my brother and we went all in together on it, because I just knew what was coming. And I've been telling everybody for the last, since 2019, I know. And when I found strategy in 2020, it was interesting to me. But in 2024, I knew what was going to happen. And so the point of this is, like, when you look at the history of money in this world, it's been manipulated since the beginning of time. And it goes all the way back to the Roman Empire. The Roman Empire were the first diluters of money. You guys know this, right? Like in their gold coins, they started diluting it with tin and copper. So when you really look at it, like the printing of money where you dilute your currency, which is happening with the US dollar, that was happening back in the Roman Empire. They were cheating. They were like, here's gold coins. No, it's not gold coins. It's gold that's watered down with tin and copper and all kinds of other crap. So that's one of the reasons why the empire crashed, right? Manipulation of currency. So this has happened for years and years and years and years. And then when the first banks came out, and you look at the history of banks, the banks, people went in, they deposited their gold initially with these goldsmiths, and they would get like, here's my gold and here's a piece of paper for gold, because nobody wanted to walk around in the streets with gold, right? It's kind of a pain in the ass. I got to go to the market and carry around sacks of gold and go buy some sugar or go buy some, chickens or go buy some cows or whatever, like you don't want to walk around with gold. So they walked around with paper, put their gold in the bank, and they walk away with paper. And these paper are certificates that are equal to the value of the gold they deposited. But what they found is the bank started fudging the numbers. And so the gold, if there was $1 of gold put in the bank account and they gave them $1 slip, they would loan that gold out 9 or 10 different times. And that was the birth of what's called the fractional reserve lending system today. And the fractional reserve system basically says that when you put $1 in the bank, they can turn it over and loan it out 9 or 10 different times. And that's how the banks work. And they're still doing it to this day. And if you go back hundreds and hundreds and hundreds of years, when it first happened, that was the first manipulation of, you give me your gold, I'm supposed to keep it secure, but I'm not keeping it secure. I'm leveraging it 9 or 10 times. And that's the birth of banks. And what they're doing, and they still do that shit today. And it's crazy, right? So when you look at traditional finance, if you're new to Bitcoin or you're new to strategy, I mean, this is why so many people are looking for solutions, because you have you have what's been going on with the manipulation of currency for years and years and years, and the banks using your money and paying you what, 0.1%, 0.5%, 1% in good times in your checkings and savings. Like, come on. Okay, great. When inflation and when rates go way up, maybe you're getting more than 1%. Okay, but it's crazy. So that's what's happened. And so, the impetus behind doing this was like, if somebody's new to Bitcoin or strategy, or they're new to Bitcoin, they should study Bitcoin first. Like, one shouldn't go and study strategy if they don't know Bitcoin. You should study Bitcoin first, know Bitcoin, and then take a look at strategy. So when I started putting the timeline together, I'm like, the first thing we need to tell the public, which is why I'm writing this book, we need to tell the public of what is the history of money. And people can trace it back and see how money evolved and how money got corrupt. That's number one. And then number two, you need to look at the issuing of these financial products and how the American public doesn't get ahead with these financial products. And then you can then look at the problem and how glaring it is, and then you can introduce the solution of Bitcoin. So if I were to pitch somebody on Bitcoin like a friend, like I did with my 82-year-old stepfather and many other friends that I've just pitch them on it, because I'm not doing it live on YouTube. I won't pitch anybody on it. But when I'm pitching a friend on it, I walk them through the problem. And so if you want to get anybody to actually take action on something, you have to actually show the problem first. This is just basic sales, right? My other career is, I sell from the stage, I sell online. I'm a sales guy on many platforms, right? So you don't introduce a solution without introducing the problem. And so introducing somebody to Bitcoin and then strategy, you got to introduce the problem. So you introduce the history of money, and then you introduce the problem of financial products. And most people who own these financial products don't know. Go ask one of your father or your mother, like, what are the fees that they're paying to their advisor? It was so funny. Like, I was taking my money off a platform from a trust that I have. And as I was taking my money back and to control it, because I wanted to control it and I didn't want to do what I was doing with it anymore. And I didn't want this other group to control it. I took it back, and they're like, hey, we can control it outside the trust, but no problem. We can manage it, and we can manage it on Schwab or whatever. I'm like, manage it for what? Like, I'm investing this money in Bitcoin and strategy. Why do I need you to manage the money? Well, you could just do it on our platform. And I'm like, can I do it on your platform? And what does it cost me to do it on your platform? Oh, just 25 basis points, like 0.25%. Just 0.25%. I'm like, dude, do you even know that if I put my money in here, how 0.25% will erode the shit out of my money over the next 20 years? Like, do you even know? Yes, you know. That's why you charge people, hey, it's just 0.25 basis points. It's not. It's going to cost me a fortune. And I'm like, get out of here. Give me my money back. Okay? So that's the idea of what you're dealing with in the marketplace today. And sure, do advisors need to get paid? Yeah. Do people need to make a living? I'm not knocking on that at all. Somebody needs to make a living. I think if somebody's making a living, there should be a traditional recommendation if that's what they're doing as an advisor. I'm not a financial advisor. I'm not giving financial advice, but if that's what they're doing, they should be looking at the scene and looking at, okay, great. If I have somebody invested in these mutual funds that are supposed to do 10% over the next 20 to 30 years, that person's not getting ahead. They're not. It's the illusion that they're getting ahead. They're just not. And so if I'm a financial advisor and I'm saying, or put money into, cash value life insurance where you can make 5% tax free, and it's like making 8% before taxes. Great. And I sold life insurance before. So now I'm looking at this and going, great. Okay. That might have been an option prior to the introduction of Bitcoin. And it may still be an option with people's safe money. I'm not saying it's not. But great, 8% on my money, or 5%, let's say, versus I could hold it in Bitcoin over the next 4 years. And what do you think Bitcoin's going to go to? So it's like, great. I understand that people who are not educated on this stuff want to hold money in life insurance, that they want to put money in mutual funds, or they want to put it with an advisor who's going to charge them a fee because they have no control over their money. And if they have no control, that means they don't have a lot of responsibility over it either, right? Because they don't have the knowledge on it. Understood. I get that. But ultimately, one needs to look if their client, or if I was sitting here looking at my portfolio and I was sitting in insurance and S&P 500 and mutual funds and stocks that I own that my advisor charged a management fee on just to control and manage my stuff, I would have to look at my situation and go, great, if that's my belief and I'm going to do that, can I at least look at like 10% in Bitcoin? Because how am I going to get ahead with 10%? How's it going to happen? You know, it's just not. And so one needs to understand that. And then you look at the 401k hoax. I mean, talk about the biggest hoax on the face of the planet, man. You know, I mean, all it is a tax delay. That's it. I give you my money, right? And I get a tax deduction. No, it's a tax delay. I get a tax deduction now so I can give you all that back in the future. That's what a 401k plan is. And the amount of wealth and the amount of people putting money into 401ks in their workplace, they're just electing and taking the choice of like, hey, here we go. I'll push this box because this mutual fund share sounds really good to me. And my friend at lunch who knows nothing about it clicked the box too. So I'll click the thing too. And they're making these investment choices like it's blind. And they're investing in a vehicle that they get a tax deduction for. And the only way you're going to be in a lower tax bracket when you retire is if you're poor. Let's face it, right? So like, great, you can get a tax deduction today. And then when you take it out 30 years from now, when you're 59 and a half and you take it out, you'll be in a lower tax bracket. Yeah, if you're poor, you'll be in a lower tax bracket. You know, and it's tied up for 30 years. And if you want to access your money, you get whacked with a 10% penalty. First thing I did when I got out of financial services, I cashed in my entire 401k. I'm like, I'm out, dude. I'd rather take that money and invest it in my business and bet that money on me than lock it up in a vehicle that's tax deductible, right? Tax deductible. And I can't touch my own money. So, and now all the institutions that are holding the money, they're leveraging the money, they're touching the money, they're using money. I can't use my own money. How is that even, like, the money's supposed to be used and put to work? How does that even make sense? How is that even allowed? How is that even allowed? It's like, hey, we're going to go into business together. Would you do this business deal? Let's do a business deal, okay? Let's go into business together. You put up all the money. So you give me the money. I'm going to lock it up. I'm going to give you a tax deduction for giving me the money, but at the end of the day, I'm just going to take those taxes back when you take your money out. So it's not really a tax deduction. We're just going to call it that, okay? But it's not a tax deduction. And I can use the money all I want because I'm controlling the money. I invest the money. I do what I want with the money, but you can't touch it. And I'll use it and I'll leverage it. And oh, by the way, when you do want to touch the money, it's going to be 20 years from now when you retire. Oh, and if you do want to withdraw it, it's a 10% penalty. Would you do that business deal? Not in a million years. Not in 1,000,001 years would you ever do that business deal. Ever. Ever, right? But people are doing that deal all day long. So the point is, these products, one needs to look into them. And, you know, just like anything, one should look into Bitcoin and understand it before they do it. If they do it, one should look into strategy, sure, and understand it. One should understand anything they do. And one might decide, hey, Bitcoin's not a fit for me. Or strategy is definitely not a fit for me. They could come to that conclusion. But the fact should be laid out on the table that if your 401k is your best option, I don't know, man. We got to do something with this economy because that's not that good of a deal if you ask me. Okay. So I think the financial products out there, I think it's time for a change. Thank God Bitcoin came along. I mean, who's super grateful that Bitcoin came along? Come on, man. Right? Like, holy cow. Thank God. I mean, who up until 2018, I was like, dude, like, yeah, I had money in Tesla, I had money in Amazon, but I was like, where would I want to put my money? Like, I was putting money in things that I'd never believed in. I was like, this is awful. And finally, Bitcoin comes out. Finally, something I believe in. Finally, something that scares. Finally, something that's finite. Finally, something that's digital, so we're not in the damn Fred Flintstone age anymore. Yabba dabba doing to work with our feet out our car, right? I mean, it's like, come on, we got self-driving cars now, man. Let's wake up, right? So thank God, King of Darkness saying, right? Thank God it came out, man. So and it's you know, the slogan Bitcoin is hope because it is. It's hope. Your everyday person who's investing money, who doesn't know money about finance, we have an opportunity to educate them on it and share it with them. And I think it's our responsibility to do it. That's why I'm here. I just really think it is. I think it's a great thing. I think it's a wonderful thing. And I think it's important. So thank God, man. And sure, traditional finance is coming in and manipulating Bitcoin, taking advantage of it, using leverage. But strategy is using leverage. You're using traditional strategies that have been used in finance for 100 years, 200 years, and they're using these strategies like leverage to buy more Bitcoin. Great. Wonderful. And many other companies are doing to buy Bitcoin. Great. Wonderful. At least they're buying something that I believe in, that I think is going to be good for the economy and good for companies in the long run. So this is just very, very good news, and it's out with the old, man. And the old guard, man, the old finance needs to just take a break, dude. Like, take a break, okay? Because it's finally something that's good, that's actually, I think, is really good for the public. There are some things in financial products that are out there that are good, but I think it's few and far between, if you ask my personal opinion on it, okay? So, and it would be interesting for you to do an experiment and take a look at the cost of your money. What is the total rate of return on all of your money? And to give you an experiment to go home and do this with, like, literally take a look at everything. Take a look at your debt payments, like the interest rate if you have any debt where you owe debt and you're paying interest on it. We'll look at the interest rate you're paying on all your debt. Look at the rates of return that you're getting on your money, whether it's bonds or stocks or mutual funds or Bitcoin. Look at the rates of return you're getting. And then also take a look, when you factor all that in, take a look at inflation. Factor that in. You would also have to take a look at, planned obsolescence, right? You need a new refrigerator, you need a new TV, you need a new iPhone. When technology becomes obsolete and you got to buy more of that, that's a cost, right? So when you take a look at all these factors, inflation, planned obsolescence, the printing of money that's an average of 6.7% a year or 6.5% a year for the last 100 years. The printing of money has been going up by that much, almost 7% a year for the last 100 years. So when you factor in all of that, could you honestly sit here and say, and you factor in debt and you factor in credit cards, can you literally sit here and say, can one look at it and go that I'm getting ahead with a 10% rate of return? No. One's barely treading water with that approach. It is. So this is a breath of fresh air. And I can't wait for it to ride up and for people to win. And also, then you look at the flip side, because you're going to have people come in with a totally different point of view. So I can take on that point of view also and just go, yes, okay, you're right. Bitcoin is volatile. Strategy is extremely volatile. And so you're going to have big ups and you're going to have big downs. And so in looking at that, one needs to look at, okay, if I'm looking at I'd rather take 10% steadily a year then something's going to go up 100% and swing all the way down, and I'm going to lose money. And there is that counter argument for it, for sure. And that's what you have, different points of view in the marketplace. So looking at that, one could then say to that argument and give another counter argument and just say, okay, well, if I held Bitcoin over a 4-year period, the likelihood of me making money over 4 years is extremely, extremely, extremely high. So there's the counter argument to that. And if I look at my portfolio of Bitcoin 4 years from now compared to the S&P 500, who's going to win? You can look at it historically. It's not even in the same ballpark. And if you look at the S&P 500 from August 2020 of when strategy first emerged and got in the game, and you compare the S&P 500 to strategy over the last 5 years, I think strategy's rates of return are like 3,000% over the last 5 years. Fact check it, right? But if you look at it, it's like something like 3,000%. You compare that to the S&P 500, there's no comparison, okay? It's not even in the same universe. It's like you would be oscillating with a vibration that like strategy would just eat up the S&P 500, which over time, Bitcoin will eat up the S&P 500, or at least give it a run. And strategy's returns are, and when I say eat it up, I mean more and more wealth will flow into Bitcoin, and more wealth will continue to flow in it over time, just like lots of money's flown into the S&P 500 over time, okay? So when you just look at those rates of return, S&P compared to Bitcoin, I mean, what do you think is going to be up over the next 4 years? I can't give you that advice, but I know what my pick is on that. And if you look at strategy over the next 4 years, what do you think that's going to be up comparatively to S&P? However, looking at strategy, I would honestly just like riding that up and down, that will be painful. Okay, I could just say that. So I can ride Bitcoin up and down. I've flexed the muscle on that for the last 7 years, but strategy riding it up and down over the next 4 years without selling and taking profits, I don't have that muscle yet. So those of you who do, kudos. I don't. I have a muscle that's like profits are that way, man. I'm taking the profits and I'm running once we start to overheat. So hope this serves you. If you have any comments or thoughts, you can leave them down below. It's always fun to be here. And we got Kooky on here. We got King of Darkness on here. We got Carlo on here. My pleasure. We got Sandra on here. We got Michael on here. So we got a bunch of people in here saying hello, which is cool. And MSTR too. Yeah, thank God for MSTR too. I believe that's true. And JMF is saying MSTR is my greatest rate of return by far. Mine too. There's not even, I mean, like, there's not even a comparison. I mean, my MSTR is smoking Bitcoin. My Bitcoin positions like a year and a half ago were my largest percentage of my portfolio, and MSTR just dusted it. So, you know, that's the position we're in right now, present day. So decisions and focus on higher, you know, and let's go higher into the future. All right. So I hope this all serves you. Again, this video is just for information, educational purposes. I'm just giving my opinion based on the research and data that I have. You do your own research, get your own data, make your own financial decisions. And I hope you guys enjoyed this, and I'll see you guys on the next show. Okay. Stay well.